when they squeeze the money supply, all those assets, the tech equities, the Bitcoin, they get hammered down.
Your thoughts?
My thoughts. I'll give thoughts in three categories: Bitcoin, the macro economy, and then the crypto or micro economy of crypto. And so if I start with Bitcoin, the first observation is I'm not a trader. I think that you need to be a professional proprietary trader to have a short time horizon. So I don't really think anybody should buy it unless you have a 4-year time frame, and I'm hoping that you want to own it forever. I think that Bitcoin is one of those forever assets, like the family farm, or like a trophy. If you bought like the New England Patriots or a soccer team, you want to give it to your heirs. So I have a lot of opinions about the long term, 4 years to 10 years out. I don't have any particular useful advice over the next 4 weeks, and I'm not a technical person. So yeah, I think it's the two thoughts. One, a rational strategy is dollar cost averaging into scarce, desirable assets that, someone that's more affluent and more informed than you will want to buy from you in a decade. So if I was trying to come up with a plan to manage through the chaos, like I don't know that I could time the market. I think that I would just kind of dollar cost average my cash flows into a portfolio of property that was scarce, that was desirable, that would hold its value, and with the caveat that I need to be able to afford to maintain it. If you look at the 4-year simple moving average of Bitcoin, it kind of reflects something synonymous to the book value of the network, because for 1,458 days, that number reflects the trading volume or the trading price of Bitcoin. So it's traded billions of dollars a day, 1,458 times. And so by the time you calculate that number, it typically lags the overall price, but it's gone up consistently for the history of the asset, for obvious reason. And right now, that number is, as of today, it's 21,705. So 21,000 and change. So Bitcoin is kind of touching that number for obvious reason. Bitcoin hasn't looked this cheap since March 20th of 2020. Like that was the last time when it touched this. And then you got to go back to like February of 2019. And then you got to go all the way back to 2015. So I think if you look at the near term, Bitcoin looks like a volatile risk asset in the near term. And if your time frame is near term, if it's a high frequency time frame, then you kind of got to trade Bitcoin like a high volatility risk asset, or an amped up risk asset. And if you're a low frequency, long-term trader, if you're buying it with expectation that a decade from now, it'll be worth more. Now it starts to look like a store of value, non-risk asset, because there's no management team, there's no product cycle, there's no employee base, there's no competitors. It's not a company. It's got no nexus. It's not in a country. It's not land. You can't produce more of it. It's a different thing. So depending upon whether or not you're short time frame or long time frame, you see it differently. And I think that in the near term, it's pretty clear it's a risk asset, and the Federal Reserve is going to control all the risk assets. And so when they when they squeeze the money supply, all those assets, the tech equities, the Bitcoin, they get hammered down. And to your point, it seems reasonable at some point they'll lighten up. We're going into the midterms, right? So the things that are constraining risk assets right now are the war, foreign relations and the war in Ukraine and the Russian foreign policy and the monetary policy. And those could very well change. If they don't change, then all the risk assets will have a hard going for the next year to 2 years. Well, so let's zoom out a bit, because I'm not a high-speed trader. I'm not a highly frequent trader. I buy, I don't sell. And so if you look at the decade and you look between here and the year 2030, or look out 8 years, there's a macro trend going on, and the macro trend is the demonetization of equities as some of that monetary premium flows into Bitcoin, and the demonetization of gold as some of the gold's monetary premium flows into Bitcoin, and the demonetization of bonds, and the demonetization of investment, second home investment, real estate. So all of those things are store of value. They've been monetized. It's simple to prove they've been monetized. You can, by just checking their correlation with the Fed balance sheet, and as the Fed expands, and their asset prices increase. And so the difference between today and 2008 and 2000 and 1990 whatever two and 1974 is, in 1974, you had this massive macroeconomic chaos, and we monetized gold. And gold went from $34 an ounce to $800 an ounce. This is the first time where we've had the potential to monetize a digital scarcity, which is what Bitcoin is. So it's still too early to say that that's a mainstream thing. It was not an institutional grade asset at all at the beginning of 2020. MicroStrategy was the first public company to make any material commitment to it. That's August 10th, 2020. But if I make a list of all the things that cause Bitcoin to trade down, right? If I make a list of the parade of horribles, right? Let me name my pain. and they're all going to reasonably reverse in the next decade. But here's what they are. One, wash trading. You can wash trade crypto and you can wash trade Bitcoin, and there are no wash trading rules. Wash trading is an immature affectation of the asset class. You shouldn't be able to do it. It could be fixed by Congress and the House Ways and Means Committee. When the IRS or somebody fixes it, then the asset will be less volatile. The crypto exchanges, offshore and onshore right now, are unregistered, unregulated, and they offer 20x leverage. So the unregulated crypto exchanges are liability number two. The third is the crypto tokens, 19,000 unregistered securities, right? And they're all cross-collateralized with Bitcoin, right? When Luna shot to the sky, they're buying Bitcoin, and when they're crashing, they're selling Bitcoin. So if you look at ETH and you look at all the other crypto tokens, they tend to trade with a high correlation to Bitcoin, because on Saturday afternoon, you're pledging Bitcoin as collateral against your Solana margin loan as it crashes, and you're getting a margin call. So I think the story was like, and that takes me into my number 4 point, crypto hedge funds, or what we'll call the wildcat banks. Luna was one, but Celsius, and there's a whole list, right? 3 Arrows is crashing today, I guess. Then the fifth liability is ignorance. Just a lot of people, they go, every time someone criticizes crypto, I go, well, if you use crypto and Bitcoin interchangeably, that means you don't know what crypto is, and that means you don't know what Bitcoin is either, right? So it's a meaningless phrase. And the lack of regulation has allowed all of the wildcat crypto hedge funds to have a meaningful impact on the price of Bitcoin. right? And if they actually regulate them and they take out those crypto hedge funds so that they can, and the crypto exchanges, so they can't exercise undue influence over the price of Bitcoin, it would do a lot of things. It would immediately decrease the volatility. But there are a lot of mainstream banks, mainstream insurance companies, mainstream market makers, mainstream investors that won't invest in the asset class because of the slime that gets onto the asset class from all the other unregistered securities, which have created a very bad reputation for all of us. So the other things are the lack of a stable coin. And by that, I mean, right, UST wasn't a stable coin, and Tether is an unregistered security without any transparency, right? And so there's never ending Tether FUD, never ending. The closest thing to a stable coin is maybe Circle or the Paxos offerings, right? Because there's some clarity. But, if the SEC said, okay, you have to file your assets at the end of every day, like that's what they do with an ETF or an ETP, right? Like if you're ARK investment or you're something, you're actually publishing what you're holding.
Right.
So if there was clear high frequency transparency and they said, you have to hold this mixture of assets and you have to publish every week or every day, you would have a stable coin. And then finally, a lot of people that are bears, say, well, there's no clear use cases for Bitcoin. And the clear use cases are going to be on the Lightning Network, on the layer 2 and the layer 3. And so as Block and Square and Cash App and PayPal roll out better offerings, and as all the companies, like my company's working on Lightning offering, as other companies roll out Lightning-based offerings, then people are going to say, okay, well, this is the base layer, but there's layer 2, layer 3 ecosystem. And they're going to get very comfortable that this is high velocity money, right? Why is Bitcoin the best money in the history of the world? Well, first of all, because you can't make any more of it and you can print a lot more gold and a lot more paper. But second of all, because it's money at all frequencies, it's money you can reasonably hold 100 years without trading, but it's also money that you can reasonably hold for 100 milliseconds before you trade it. So when people see that it's high frequency programmable money, and it's also low frequency store of value money, and it's better than Visa at moving money fast, and it's better than gold at holding money a long time. When they see that, then light bulb goes off and they go, wow, this is a better way to store money. And then of course, why would I hold a big bond fund yielding 3% for 30 years? Right? I mean, you're not giving that money to your grandchildren, generating 3% yield right now. It's just not going to happen.